Look, investment markets for fiscal 2018 at a headline level performed quite well. We had double-digit returns in things like global and listed shares. We had reasonable returns in property, but then it got a little bit more differentiated. Things like bonds as an asset class delivered about half of their 30-year average return of about 7%, returning just over 3% for the year. And things like the Australian dollar actually fell for the year and posted a negative return. But if we dig below the headline numbers, it was a really interesting story. Like the first half of the year, so to December 2017, was very, very different to the second half of the year. And we saw much higher returns consistently across asset classes in the first half of the year. And this was really because investment markets were quite buoyed by things like strong economic growth, a continuation of good economic prospects out of the US. We had the benefit of tax cuts in the US being talked about, and this led to expectations of good corporate profit growth. In the second half of the fiscal year, we had a material change in investor attitude towards risk, and that was how fast are interest rates going to be going up in the US? Is there a bit of a slowdown occurring in the Chinese market? We've got the talk about trade wars, and then we also have the prospect of what we call quantitative tightening, which is liquidity withdrawal from markets. So hence we saw some very differentiated and much lower returns in the second half of the year. Look, the outcome that we saw in the second half of the last fiscal year, we think really sets the blueprint for how markets are going to behave going into the future, and that is high levels of volatility and lower returns. And really what it signals to us is we are in the latter stages of a very elongated bull market, and valuations are not cheap anymore. Pretty much all investment markets are at or about their all-time highs. So when markets are cheap, and indifferent news comes along, they can absorb them more. When markets are fair value or more expensive and indifferent news comes along, they're going to be more volatile. So you're going to see that come into return streams. But there's really importantly, and we've been talking about this for a while, two key structural factors that are impacting markets this year that have been really significant tailwinds for markets in recent years and since the global financial crisis. The first is that after 30 years of lower interest rates, we're now going to start to see interest rates increase. And you can see the expectations for US 10-year Treasury bonds is actually starting to rise. That's a very significant difference. The second is we're moving into a period of what we call quantitative tightening. So since the global financial crisis, we entered pretty much globally coordinated era of central banks providing liquidity into markets. It was commonly referred to as quantitative easing. So those two factors of quantitative easing and lower interest rates have been material benefits and provided benefits to both economic growth and market valuations. So we're really starting to see them turn around, and they're now going to start moving in the opposite direction. And this has some pretty significant impacts on markets. Look, when considering the outlook for markets and portfolios now, there's a few things to consider. The first is we're actually in a really supportive economic environment. So the US is performing well, Europe's doing okay, China's slowing but it's manageable, so we've got a good backdrop for delivering corporate profits. What we've got to balance that with is, as mentioned, the impact of rising interest rates, what that means for consumers' debt, what that means for market valuations, and then also we've got quantitative tightening or the withdrawal of liquidity in markets. So these will be factors that have been tailwinds that will now be slight headwinds and will create some market volatility. So the other consideration is the risk or the implication of trade wars, which is playing out in markets at the moment, and it is quite an uncertain factor. So pulling that all together and what it means for market outlooks, given where valuations are sitting and given some of the uncertainties that are prevalent in markets at the moment, we think there is an increased likelihood of lower returns than we've seen historically across investment markets. Given we're in the latter stages of an elongated bull market environment, which could continue for some time, there are three clear things that we want to be focused on. The first is risk, how much risk we're taking in portfolios. We don't think, given we're in the latter stages, that this is the appropriate time to be at the upper level of risk limits. So we want a more balanced risk exposure in the portfolio. And everything that we put into the portfolio, every individual asset is taken with that lens on, being a focus on the risk of the underlying investment. The second is we want to be more diversified. So we don't just want higher risk, higher volatility growth assets dominating portfolio returns at the moment. We want a larger allocation of things that diversify risk away from equity markets and interest rates. So things like alternatives and private markets. And the third thing that we want to do is we want to be active in the portfolios. We're seeing opportunities, they're more selected, and volatility actually creates that opportunity for us, but that can really supplement investment returns. Portfolios have behaved how we would expect them to behave in this market environment. So despite the fact that we had very significant differences from the first half of the year to the second half of the year, the portfolios performed on a really consistent basis. And that's one of the key things that we're trying to deliver for our clients, is a consistent return for them. And that's because we are a diversified portfolio. We have multiple levers and sources of return from which to draw on. We don't just have a single asset class, and we're very active in the way that we manage money. As equity markets rallied throughout the year, we actively took risk off the table. So we reduced our positions there. And we allocated some of that capital to diversifying assets such as private markets, which are things like direct property. Within this move, we maintained our allocation, our higher weight of allocation to international equities over domestic equities, where we have a clear preference. And another key contributor was our position in the Australian dollar. So we hold our offshore assets in an unhedged position, which means as the currency depreciates like it did this year, that actually adds to the value of our offshore assets in Australian dollars, and it boosts portfolio returns. So when we think about the environment we're in, it's low growth, there's more volatility coming, how confident are we in delivering our objectives? And we are confident, and the reason being is, one, will be active across markets. So volatility introduces risk into portfolios, but it also creates opportunities. And the second thing is we have multiple sources of return from which to allocate our capital. So we're not wedded to a single asset class like equities or interest rates. We can go across a whole range of asset classes on a global basis to seek returns, and that's what provides us with the opportunity to deliver objectives.